Hi, it's Joe Mazumdar of Exploration Insights at the Metals Investment Forum, the pre-PDAC version of the Metals Investment Forum in March. Virtual conference again, and today I'll be doing an update on the gold market given all the volatility. Then after that, we have about 5 companies presenting, exploration gold companies presenting after that, and then we'll run into a Q&A. So thanks for joining us, and let's get started. So I'm going to go through a bit on supply demand in the gold market, the high level stuff, and then get into different company specifics. Okay, first investment demand and demand overall. So this is just a chart that I developed from the World Gold Council. It's a quarterly chart of demand, between the different sectors. You've got jewelry demand, which is about 50% of demand on average, which is a significant component. Bar and coin, another form of investment, central banks, technology, which is a small part of it. But the big one that's been moving the gold price, as probably most people are aware over the last decade, has been the ETF or investment demand. So quarterly demand, averages about 35 million ounces a quarter. In Q4, right over here, this last quarter that's been documented, it was the lowest since the global financial crisis, got down to 25 million ounces. So jewelry demand, as I said, accounts for about 50% of this. But as you can see, since the beginning of the decade, we've seen this rise here in the gold price. Some of that was related to ETF demand. Definitely this fall in the gold price related to outflows in ETF demand, and then here support for gold price ETF demand fluctuating, but definitely in Q2 2020. We've had a significant amount of inflows into gold ETFs, and that's what's driven this spike in gold price. But in the latter part of the year, in Q4, we started seeing some net outflows. Okay, and those net outflows can obviously, as we've seen in 2013, have a significant impact on the gold price. Okay, and so if we looked at that again, we could look at this is 2019, 2020, and then the last green color is year-to-date 2021. And so ETF net outflows, like I showed in 2013, for the year were outflows of 887 tons. 3 years of outflows beyond 2013 pushed the gold price down to about 1160, which is an average price for the year. ETF demand in 2020 here was up about 27%. Most of that was driven by US ETFs. And that was about as high as the down outflow in 2013, which was 887. This was 877 tons, more than a decade peak. But the trend, like I showed before in Q4 20, has been negative, so outflows. And so in 2021 year to date to the end of February, there's been a 6% decline or outflows in ETF demand. It's not it's not as big as it was yet, but I mean that trend, all I'm saying, from Q4 has continued into Q1 of 2021. So if we look at what's driving this, so the relationship, basically what investors that are into ETFs and investment demand in gold, what they're watching is the real rates. And so as we know, gold has no yield. And so if bonds don't return a yield or they're negative, then gold price looks all the much better. And I've said this before, in the January Metals Investment Forum, we saw this big switch between the tips going up, from negative 0.6% to 0.6% positive, which is about 100 basis points, 80 basis points change here. And 100 basis points change here. And then it was a slow decline to August when gold peaked at over 2,000. Since then, it's been volatile, as well as the tips rate between -1% and -0.8%. But this recent kick up in the TIPS rate, which is the inflation adjusted interest rates, that's what's driving the gold price down. And that's what the people who are buying it as ETFs and inflows and outflows are watching. And it doesn't matter that the absolute number is negative, which is good for gold. It's the trend that matters. If the trend is like going from minus 0.2% to minus 1%, that's great for gold. But if it's negative from minus 1% trending up to minus 0.6%, that's still bad for gold, because it's really about expectations. And speaking about expectations, what's driving a lot of the sentiment that even though the Federal Reserve is saying that they're a long way from their inflation targets, or like around 2%. So the idea is that they're going to maintain an expansive monetary policy, at least till 2021, for the rest of 2021. But the market thinks that inflation expectations are higher, their expectations are higher. And so the red line here for both graphics are basically the long rate, the rate that the Fed wants to keep inflation at below. The upper graph is basically the market's expectations from the University of Michigan. And the bottom is basically the break-even rate that is defined by that formula right there, about 1 plus real rates plus inflation rate equals the nominal rate. That back calculated suggests that the inflation rate expectations are below 2%, but the market thinks they're over 3%. And that's the dichotomy that's driving yields up. Okay, and so if we look at gold supply quarterly is about 35, 36 million ounces, of which 2/3 of that is mine production. And what I just want to highlight here is what happened in the second quarter of 2020. So in the second quarter of 2020, if the average gold production was about 26 million, it was about 25 million ounces in Q2 2020. So a drop of about 1 million ounces from the average. But it's recovered. In the last 2 quarters, it's gone up to about 28, 29 million ounces. So we have seen a recovery of supply from mines. What's other thing that's interesting to watch is recycled gold demand that fills the rest of the demand. So it peaked in the first quarter of 2010 at 14.8 million ounces, but on average, it's about 10.6. This last quarter, it's been over the average, saying that recycled gold is taking advantage of higher gold prices. So if we look at specific companies, this is the top 10 gold producers, which includes gold producers, major gold producers, but also polymetallic producers that produce gold as a byproduct. And so they produced about 9 million ounces in Q4 19. Okay, but they produced 3% less in Q4 20. So that was about 270,000 ounces. So the production of maybe a tier 2 asset was what net was reduced. But as you can see, we're talking about some big negatives for some major producers, like Barrick was down 16% year on year in terms of quarterly production, Newmont down 11%, and Anglo down 18%. So they were definitely negatively impacted by the COVID-19 pandemic. And if we look specifically at a company like Pan American, and I do this because I own shares of Pan American, but also a lot of where we saw the negative impact from production was in Latin America, and specifically Latin America and underground production. And so Pan American year on year saw a 33% drop in silver production and a 40 to 41% drop in their polymetallic. What helped them a lot was gold production from underground in Timmins in Northern Ontario, which was not as negatively impacted by COVID, and also open pit production from Peru, which was not as much negatively impacted. Their increase in all-in sustaining costs was partially because they produced less byproduct revenue, and also due to the productivity losses of working in COVID-19 protocols. So if we talk about the majors, so what helped them, because of the production shortfalls, what did help them is the big rise in recognized gold price. And so their realized gold price went up 24 to 25%. But companies specifically, because they saw a lower realized in realized price in 2019 saw increases of 25 to 28% in the gold price that they saw versus 2019. And that had a big positive impact on cash flow generation. And another positive when you're looking at gold companies is what prices they're actually using to generate their reserves and their resource prices, because that's the quality of the assets that are actually being operated upon, and that's the quality of the assets that are fitting through the pipeline. And so in the gold price is up over 50%, annual prices up since the low of 2015. Okay. But gold prices that are used to actually calculate reserves are up by 50 to 20%. So there's a bit of a gap here. So back in 2015, the actual price of gold versus the reserve price was a difference of maybe $10. Now it's well over $200. And for some specific big companies, it's well over $300. Okay, so we're being a lot more conservative on the gold price with respect to reserves. Resources are always a higher price, but in 2015, the resource price used to calculate, the price used to calculate resources in 2015 was actually higher than the gold price. Now it's actually $300 lower. So you got to know that, in terms of what you're investing in, a lot of these guys are still using conservative prices to derive their models. So, even though gold price is volatile, a lot of companies are still way under the current gold price. Okay, and so this is a slide from Pan American, but this is something most companies are looking to do with their free cash flow. So that free cash flow is specifically going into growth projects with higher return on invested capital, but the assumptions they're using are lower than the current gold price. The other thing is to use that to pay down debt. And the other one, lastly, is to increase dividends to attract more generalist investors. And those are the three buckets most companies are looking at filling. So specifically with Pan American, you could see this $541 million of adjusted operating cash flow despite the production shortfalls, which was mostly driven by the rise in commodity prices. And so overall, with that generation of operating cash flow, they've been able to eliminate basically their $275 million of debt, which stands at zero. And even after paying back that debt, they still ended up $41 million in terms of cash, which is a very big positive for companies. And so if you look at the bigger industry picture, 24 companies here with with a cumulative enterprise value of about 186 billion. Their average net cash, so working capital minus their long-term debt, was just under 90 million negative, which is a much better improvement than the last cycle. And 40% of these companies have positive net cash positions. So in terms of their balance sheets, they're much better to withstand volatility in the gold price going forward. And now back specifically to Pan American, you can see that in 1 year, 8 quarters, they were basically able to switch their net cash position from negative 213 to 279 million. So that's a $492 million flip in 8 quarters because of strong commodity prices. And one of the buckets that this money is going into is dividends. So you can see they were having a dividend per share policy of about 3.5 cents per quarter. And they've managed to double that in a year to 7 cents. And that's not unusual for what we're seeing with producers. And this is also, a goal to get more generalists. And in terms of growth capital, because of COVID-19, a lot of companies had to defer the capital, both sustaining and growth capital in 2020 because of COVID protocols and just issues with suspension of projects and things like that. And so, basically, these guys are looking for a big increase, Pan American, in sustaining capital, up 56%. And then in terms of their growth capital, up 150% for their organic discovery, which was La Colorado Skarn. And so, but despite that, despite the operating cash flow they're generating, despite the fact that they're paying down debts, despite the fact that they're basically increasing their dividends. In 2020, on average, year to date, I'm sorry, for the whole year, they didn't do much better than the gold price. So that's sort of telling you that they're underperforming. And then year to date, to the end of February at least, they were down 17%. So despite the conservative prices, despite the strong balance sheet, they're still not outperforming, not even the gold price right now. But if you look at Pan American, one reason it did better, like it peaked with the gold price in the middle of August or early August, but around here where we saw the silver squeeze, you could see this huge spike in volume in Pan American. That's what's helped it actually outperform the GDX and also the gold price, basically because of the silver squeeze. So diversification is important. So getting to juniors. So with the juniors, equity financing transactions in the summer here, we saw 3 months in a row of 300 or more transactions, which is a big positive. We saw an increase in financings for gold equities. But what we're seeing now with the current spike in December, although we're seeing more gold equity financings, what's taking a bigger chunk of the pie right now is base metal and especially commodity financings, as people are looking for infrastructure spending. Copper is going up, nickel for electric vehicles, lithium, all these other commodities are making a big comeback as well. So albeit the majority of the $300 in equity financings here were non-gold, there was still $1.5 billion raised. And so looking at news flow, and so this is a number of distinct projects, and this is the number of reported drill holes. So what you can see is that the majority of distinct projects are still gold. So gold projects are still generating the majority of the news flow and the drilling results, going into December. And that's just something we're going to see going on going forward. So out of the 270 distinct projects, about 75 to 80% are gold related. And interestingly, if we go back to how we calculate reserve and resource prices, the majors and the intermediate producers, as you can see in this graphic right here, are driving the average reserve price down, whereas juniors tend to use a more aggressive price right now to show better feasibility studies, scoping studies, and that. But what we've seen also in terms of stage, the pre-feasibility study ones tend to use a bit of a higher gold price than the ones that are currently operating. So that's a bit of aggressive nature of the juniors versus the producers. So in conclusion, the higher US long-term bond yields obviously negatively impacted the gold price, but consequently also precious metal equities, and they're down despite decent balance sheets and despite the fact, that they're using more conservative prices to drive their financial models. So the realized prices did a great job for them in 25 to 28% higher realized prices, and that more than offset the production shortfalls due to COVID. Again, 3 buckets that they used: pay down debt, so they've got healthy balance sheets, fund organic growth projects. Some of that was deferred in 2020, so we should see more of that in 2021. And then increasing dividend payouts to attract generalists. That's still what they're doing. But also healthy balance sheets, they're still divesting projects. And we saw that recently with Barrick with a gold project in Peru, I believe. So, but despite all that, precious metal equities continue to underperform. And right now, they're not producing a lot of upside leverage to gold unless they have some silver right now. So in terms of access to financing, gold juniors still are able to access the market, but right now, taking center stage is a lot more non-gold assets. But still, in terms of distinct project, most projects are gold assets. And that's what juniors are running with. But right now, there might be a window here for exploration plays to potentially outperform producers as they generate positive news flow from their drilling results. So that is, a little bit of a light here in these dark times. And what juniors have to look at, if they are looking for suitors, and if they are M&A targets, they might have to bring their prices that they're using to generate resources and reserves more in line with the potential suitors, such that they could see that that would be an accretive transaction.